Hi, and welcome back again to Bigham Research. We'll be taking a look today at Firefly Aerospace, FLY, where big, unusual option activity, almost all on the call side, set up ideally for two trades. One to follow the flow with a simple covered call trade and capture the vol as well. And the other one is straightforward vol capture trade, fairly neutral, selling a strangle with both the put and call out of the money. So let's jump in and take a look. As we said, we always like to use the market to find the edges. We saw big, unusual option activity. We'll see that in a second. IV certainly at extreme, so favors selling option premium absolutely. So reaching the extremes when it gets to these levels, it certainly makes a lot of sense. So let's jump in and take a look. First of all, here's the scanners that I kind of use throughout the day, day in and day out. Here's Firefly Aerospace, as you can see, showing up right near the top of the scanner, right? You can see over 51,000 contracts traded on Tuesday, 48,000 of them being on the call side. Average volume under 7,000, so basically 8 times the normal volume. Absolutely unusual option activity. You can see IV, most importantly now, at the 100% level. In other words, option prices have not been this expensive in the past year. So sets up for a option selling trade structure. You can see here's the scanner I built on the Thinkorswim website. You can see number 2 on the list, right, was the Feb 25 calls that expire Feb 27th, right, as we see almost 18,000 of these traded. We'll take a look in a second what happened to the IV on those and why it's set up ideally to take advantage of this big unusual option activity. So as we said, the implied volatility at the 100th percentile, you can see just how much IV has jumped over the past several days at by far the highest level over the past year. You can see even from Friday to Tuesday, this massive jump, especially on the short end. Looking at a 20-day IV on the basically 25 delta call and put, you can see the IV now over 140. Last week it was trading in the low 120s, upper 110s, right? So a huge jump in implied volatility, all due to that big unusual call buying, right? The over 50,000 contracts, as we said, that traded on the day in Firefly, right, jumped the IV, which sets up ideally for a vol capture trade. You can see here's the February 27th expiration. The majority of the contracts trading there because of that Feb 27th expiration, 25 calls. So almost 30,000 contracts. Huge jump in IV, as you can see, of 23 vol points. So sets up ideally for a couple trades to take advantage of this big jump in IV. And note too, right, that the call IV now trading at a huge premium to the put IV because of the preponderance of call buying, right? So 6 vol points higher. The calls trading at about a 147, the puts at a 141. Another reason, maybe you want to jump in and sell these calls, right, as part of the overall trade. So we can take a look at a fairly neutral iron condor trade. So I pulled off from February 13th close, right, on Firefly Aerospace. You can see the stock closed at 1913. The IV on the sell strangle, right, selling the March 20 put, March 25 call was roughly a 125, right, 126 on the puts, 125-ish on the call, so right around 125. If you would have sold this, right, you would have been 15 deltas net long, which makes sense, right? You're selling a put that's slightly in the money at the time, right? Stock at 1913. You're selling the March 20 put, had a negative 46 delta. Selling it, you'd be 46 deltas long. And the March 25 call, 31 delta that you're selling. So net, you'd be slightly bullish, right? Which makes sense. You're selling it in the money put, way out of the money call, 15 deltas net long. That strangle trading right around 470 at the time. Fast forward to Friday's close, or yesterday's close, you can see the stock closed at 2038. That IV exploded to 150 though, right? Here you can see puts trading at about a 147. The calls, as we said, trading at a big premium now because of the big call buying out there. And we did see over 2,800 of these March 25 calls trade as well, right? Versus that, almost 18,000 of the Feb 27 calls. So IV exploded here. The delta now on the trade doing it, it's about as neutral as you can be, right? So we had the stock move from out of the money on the call side, in the money on the put side, to out of the money on the call side, out of the money on the put side. With the stock at 20.38, you want it somewhere between 20 and 25 ideally, so the trade should have gotten cheaper, right? But instead, that huge jump in IV from 125 to 150 made the strangle jump from 470 to 530, or up about 60 cents, so a huge jump here. So this is a way to take a neutral approach, go out, sell that March 20 put, sell that March 25 call, capture this huge jump in IV, and just wait for the reversion and take advantage of the fact that IV is one of the few true reverting things out there. Another way to kind of more follow that big call buyer and capture the vol is a simple covered call trade. So here I pulled it off going back to February 12th, the stock at 20.82, right? The Feb 27th 25 call was trading at about a buck, just a touch under, right? So buying the stock, selling that call, you would have paid about 19.85. The IV on that call right around 135 at the time. You got plenty of upside room on the trade, almost 4 points and change. So certainly you can have the stock go up, right, and be very happy on both sides of the trade. Fast forward to Tuesday, you can see the stock is actually a little bit lower than our date that we left up before on February 12th. Stock now at 20.38, but that Feb 25 call is actually up in price. It closed just under a buck with the stock at 20.82, right? Now it's trading at $1.30 with the stock lower. So you have the stock drop, the call go higher, right? That covered call got a lot cheaper. It's just over 19 bucks. Before it was just under 20 bucks. Why? This huge jump in IV from 135 on the call to over 205 on the call. You can see that sets up ideally to follow that call buyer out there, right? Lean bullishly with that call buyer, but capture some big time overpayment, hedge dramatically on the stock. So kind of putting things together here, on February 12th, the stock was at 20.82. That Feb 25 call that expires February 27th, trading just under a buck. So that covered call, as we said, buying the stock, selling the call, would have been just under 20 bucks at 1985-ish or so. IV at the time, 135. The delta on that $25 call was a 30 delta, right? So the stock at 20.82, that delta, right, was a 30 delta on the call. Fast forward to yesterday, the stock closed at 20.38, or down 44 cents, right? But because of that huge big call buying out there, right? You see that Feb 25 call actually go up in price. So you have the stock down in price from 5 days prior, the call up in price from 5 days prior, right? All because of that big call buyer forcing the price of the options higher. IV went from 135 when we were looking back on February 12th to over 200 when our trade idea germinated, right? Or a massive 70-point IV pop, right? Basically a 50% IV pop. And note too, the delta on the call actually got bigger because of this jump in IV, right? Which is unusual. You see the stock down, you expect call delta to drop, but because IV move outweighed it, the call delta actually got higher. You actually got more protection for a higher price on a lower price stock. So a great way to get the best of both worlds, we call it, right? Buying the stock 44 cents cheaper, selling the call over 30 cents more, right, leads to a covered call trade that gets in cheaper, gets more protection, right? And let's not forget, we did have a little time premium decay of about 5 days as well, which should make the calls cheaper too. So everything lining up ideally for those who want to follow the flow, jump in, buy the shares, sell these very expensive Feb 27th 25 calls. If you want to do a more neutral trade, right, you can simply do that sell strangle, go out to March, sell the March 20 puts, March 25 calls, or whatever strikes you want as far as structuring. They all have that added benefit. So hopefully it provides insight into how we go about identifying trades opportunities. But as we always say, trading is about probability, not certainty. Make sure you position size appropriately. Make sure you have your risk in place when you do the trade, right, which is position sizing, right, and also have your exit strategy, your stop predefined. If you don't know where to get out, you shouldn't be getting in. So until next time, as always, here's a good trading.